Welcome to Breaking News to Trading Moves.
Great to be here.
Yeah, glad to have you. So today, we're basically looking at a single signature on a contract. And this signature is dictating exactly where Wall Street is directing capital right now. So the headline is that Anthropic has signed a multi-year deal with CoreWeave for cloud computing capacity, with the rollout scheduled to start later in 2026.
Yeah, and that headline, it gives us a really precise map of market mechanics. It tells us exactly who is getting paid over the next few years, and equally importantly, who is seeing investment capital rotate away from them in the short term.
Right, right. And so our mission for you listening today is exclusively to look at this specific headline and identify the market winners and losers based on this exact trade flow.
Just following the money.
Exactly. We have a very clear roadmap for this conversation. First, we will examine the companies benefiting from this hardware and cloud demand. And then we will examine the companies facing pressure from this exact same capital rotation.
Because it all comes down to capital allocation, really.
Yep. We are purely evaluating the market read-throughs, the financial plumbing of, how this news is processed by traders.
Right, because when a model developer like Anthropic commits to a multi-year cloud capacity deal starting in 2026, they are telegraphing their long-term operational needs.
They're laying all their cards on the table.
They really are. They are telling the market, in plain terms, that the demand for immense guaranteed computational power is, it's not slowing down.
So let's start with the immediate beneficiaries. The details show Anthropic is securing more of this external capacity, and the immediate takeaway is that leading artificial intelligence model developers are basically in a sprint to secure compute wherever they can get it.
Yeah, it's a total land grab right now.
It is. And CoreWeave shares actually rose on this news. So for you listening, think of it like this. Compare these developers buying compute capacity to factories leasing out warehouse space.
That's a great way to think about it.
Right. Because you simply cannot build your product if you do not have the physical space leased out first. So Anthropic is basically leasing the warehouse space they know they will need to run their operations a couple of years down the road.
I really like that analogy. And, to take that factory comparison a step further, they aren't just leasing empty space. They are locking in access to highly specialized, high-performance machinery.
The heavy equipment.
Exactly.
Yeah.
Without that guaranteed access, production just halts. And that is why the market reacts favorably toward the providers that own that digital real estate.
Right.
They are the specialized landlords.
So looking at the tickers benefiting from this, we are talking about CRWV, which is CoreWeave, and ORCL, which is Oracle. But wait, let me push back a bit here.
Sure.
If Anthropic is so well-funded, they have billions, right? Why are they renting space from CoreWeave instead of just building their own specialized data centers?
Well, that is a critical question. Building a proprietary data center from the ground up requires tens of billions in upfront capital, years of permitting, securing massive power contracts from utility companies.
Which takes forever.
Oh, it's a nightmare. And managing a deeply complex hardware supply chain. You have to remember, Anthropic is a software and research company.
Right. Their competitive advantage is writing algorithms and training models.
Exactly, not pouring concrete and managing liquid cooling systems. By contracting with CoreWeave, they get immediate guaranteed access to pure-play compute without the logistical headache of building the infrastructure themselves.
Makes perfect sense.
And Oracle fits into this winner category because they are a large cloud platform offering that exact type of specialized exposure that model developers desperately require.
Okay, so Anthropic just rented the digital warehouse, but, an empty warehouse does not train a model.
No, it definitely doesn't.
You need the heavy machinery inside it, which explains why the market immediately started looking at who builds the machines. Because, CoreWeave cannot provide capacity without the underlying hardware.
Right. The cloud is not some invisible, ethereal concept floating above us. It is made of physical metal, silicon, glass, and copper wires.
It's very physical.
Extremely. When CoreWeave secures a multi-year deal with Anthropic, traders immediately grab their calculators and start working out the exact hardware required to fulfill that specific contract.
Yeah, and the details tell us that CoreWeave's infrastructure is incredibly reliant on NVIDIA graphics processing units.
Heavily reliant, yeah.
And on top of that, Anthropic signed a separate capacity deal involving Broadcom and Google earlier in the week. So this keeps the market's attention squarely focused on the chip and connectivity layer powering this demand.
It absolutely does.
The specific tickers for the chips and connectivity layer are NVDA for NVIDIA and AVGO for Broadcom. Now, the information mentions that this layer powers both training and inference demand. Could you break down that distinction for us? Because those terms get thrown around constantly.
Yeah, they do. And understanding the difference between training and inference is absolutely crucial to understanding why these specific hardware names are winning.
Okay, lay it on us.
Think of training as building a massive linguistic brain from scratch. You lock a supercomputer in a room for 6 months and feed it the entire internet.
Wow, just everything.
Everything. It learns grammar, logic, coding, and reasoning. That process requires an enormous, concentrated amount of computational power running continuously, without failure.
And so what is inference then?
Inference is what happens after that brain is fully built. It's copying that completed brain onto a server so it can answer questions out in the real world.
Oh, okay.
When you type a prompt into a chatbot on your phone and it gives you a recipe in 2 seconds, that is inference.
Okay, so training is building the brain over months, and inference is asking that brain a question and getting an answer in milliseconds.
Precisely. And the hardware requirements for both, they're heavy but slightly different.
How so?
Well, training requires tens of thousands of chips working in perfect unison to process colossal data sets simultaneously. That relies heavily on Broadcom's networking equipment to ensure the chips can talk to each other without bottlenecks.
Right, the connectivity layer.
Exactly. Whereas inference requires speed and low latency to deliver an answer to millions of users at once. Both phases, though, drive relentless demand for NVIDIA's processors and Broadcom connectivity solutions.
Which just reinforces the reliance on the entire physical supply chain. Because the chips are just one piece of the puzzle, right? More cloud capacity requires a massive physical footprint.
A staggering footprint, really.
We are talking about servers, racks, storage, and deployment hardware.
Yeah, the physical infrastructure layer is entirely critical. To house those processors from NVIDIA and the networking gear from Broadcom, you need specialized server racks.
Because they run so hot, right?
Exactly. These new chips run incredibly hot, so you need advanced liquid cooling systems. You need massive storage drives to hold the data being processed. You cannot just, plug an NVIDIA chip into a standard wall outlet.
Right, right. So the market takeaway here is that if CoreWeave continues winning large contracts, traders will keep buying into the U.S.-listed hardware names linked to that physical build-out.
That's the playbook.
And the specific tickers for this infrastructure category are SMCI, which is Super Microcomputer, and DELL, which is Dell Technologies.
Because companies like Dell and Supermicro assemble the final product. They take the bare chips, the memory modules, and the networking cables, and they engineer the actual server racks that get wheeled onto the data center floor.
So it's all very sequential.
Very much so.
Yeah.
The capital flow is highly sequential. Anthropic orders capacity from CoreWeave. CoreWeave then has to order the physical servers from Dell and Supermicro, who in turn must order more chips from NVIDIA. The money flows straight down the hardware supply chain.
Got it. Okay, let's transition and look at the other side of this trade. We have examined the hardware winners, so we must examine the business models facing pressure from this same capital rotation.
The flip side of the coin.
Exactly. Because as CoreWeave gains diverse clients, it relies less on its traditional revenue base. And this touches on the traditional cloud concentration trade.
Yeah, this comes down to market share dynamics and vendor diversification. If we look at the historical data, Microsoft accounted for roughly 67% of CoreWeave's revenue last year.
That's a massive chunk.
It is. Microsoft was their dominant customer.
But now CoreWeave is diversifying. They are bringing in customers like Meta and Anthropic. The broader takeaway for traders is that workloads are spreading across multiple providers, rather than remaining concentrated with just a few legacy cloud giants.
Right, the pie is being split differently.
And the tickers facing pressure in this specific context are MSFT for Microsoft and AMZN for Amazon. But hold on, I have to stop you there. Microsoft and Amazon have practically infinite cash reserves. Why on earth are they letting a smaller, specialized player like CoreWeave win a massive contract from Anthropic? Shouldn't the hyperscalers just dominate this space entirely?
Well, that is exactly what the market assumed for a long time. The prevailing wisdom was that Amazon Web Services, Microsoft Azure, and Google Cloud would simply swallow the entire artificial intelligence market because of their sheer scale.
Right, because they have the deepest pockets.
Exactly. But developers like Anthropic are highly strategic. They are actively choosing to spread their workloads. First, they want to avoid vendor lock-in.
Ah, of course.
Yeah, relying entirely on Amazon or Microsoft gives those giants way too much pricing power over time. Second, CoreWeave offers bare metal access to processing power, without all the heavy enterprise software bloat that often comes with the traditional hyperscalers.
And there is a competitive dynamic too, right? Because Microsoft is heavily invested in OpenAI, which is Anthropic's direct rival.
Exactly, you hit the nail on the head. Anthropic might not want to run their most sensitive training workloads on infrastructure owned by the primary backer of their biggest competitor.
That makes a lot of sense.
So the traders see this headline and they adjust their growth models. It is not that Amazon or Microsoft are structurally breaking down. It is that their expected monopoly on high-performance computing is facing very real competition.
The traditional giants are getting a slightly different slice of the pie than Wall Street initially modeled.
Precisely. And that adjustment in Wall Street's models drives the capital rotation.
Which brings us to the next group of market losers, specifically focusing on software and margin-sensitive names. Because if money is flowing heavily into physical hardware and compute scarcity to build these data centers, well, that capital has to be rotating out of somewhere else.
Capital is finite. A portfolio manager only has so much cash to deploy. When a headline like this drops, confirming multi-year capital spending on physical infrastructure, institutions want to own the companies cashing those checks today. To buy more of the hardware supply chain, they have to sell shares in other sectors to free up the funds.
So traders routinely rotate toward the hard supply chain names and away from software companies that are less directly tied to capacity expansion. The software tickers mentioned as facing pressure in this rotation are SNOW, which is Snowflake, and CRM, which is Salesforce.
Yeah.
And I want to be very clear for you listening right now. There is a massive difference between a company having a flawed product versus a company simply being on the wrong side of a temporary trading rotation.
Oh, that is a vital distinction.
Why?
Snowflake and Salesforce are highly successful, robust software platforms. They sit on top of the cloud, they utilize the data centers, they do not build them.
Right.
The headline today does not mean their products stop working or that their clients are leaving, but in the immediate term, the trading flow moves away from the software layer because the immediate bottleneck—
Compute scarcity.
Yes, the compute scarcity. And therefore, the immediate financial payout is in the physical hardware.
Let's dig a bit into the mechanics of that software pressure. The details explain that as infrastructure demand keeps accelerating, the market favors businesses seen as direct beneficiaries of capital expenditure. This temporarily pressures higher multiple cloud software names.
It does.
And the tickers noted for this margin sensitivity pressure are MDB, which is MongoDB, and DDOG, which is Datadog. So why are high multiple software stocks uniquely vulnerable to a hardware spending cycle?
It comes down to how investors value different types of businesses.
Yeah.
Many cloud software companies trade at high valuation multiples. Investors pay a premium for them based on the narrative of infinite scaling.
The idea that it costs almost nothing to add a new customer.
Exactly. The idea is that once you build a software platform, adding 1 million new users costs basically zero, resulting in massive future profit margins.
But hardware is the exact opposite of infinite scaling.
Exactly. Hardware is brutally physical. It requires copper, silicon, factory labor, and shipping containers. When a headline reinforces that billions must be spent right now on physical servers just to keep the artificial intelligence industry moving forward, that infinite software scale narrative takes a back seat.
People want what's happening right now.
Yes, investors want purer, more direct exposure to the money being spent today. They sell the higher multiple software stocks like MongoDB and Datadog to lock in the immediate returns offered by the physical build-out.
It's entirely mechanical, really.
Completely mechanical.
The news drops, traders identify who receives the immediate cash flow from the deal, and they allocate their portfolios accordingly. Anthropic signs with CoreWeave. CoreWeave immediately needs processors from NVIDIA, networking from Broadcom, and server racks from Dell and Supermicro.
The capital flows sequentially down that metal and silicon supply chain.
And as a direct result of that specific allocation, Microsoft and Amazon face a narrative of heightened competition for these specialized workloads. Meanwhile, software names like Salesforce, Snowflake, Datadog, and MongoDB face a temporary outflow of investment capital as traders prioritize the immediate physical reality of compute scarcity.
Yeah, the mechanics of the trade remain strictly tied to the physical requirements dictated by the contract. The market rewards the providers of the infrastructure and temporarily punishes those further down the utilization chain.
It is truly fascinating how one contract signature dictates a predictable domino effect across the broader market. We have evaluated the specialized cloud providers and the hardware supply chain securing the compute space, and we have examined the legacy cloud giants and the software platforms absorbing the immediate pressure of that capital rotation.
It all connects back to that one multi-year deal.
It really does. As we wrap up this focused conversation, we want to leave you with a final thought to mull over on your own. With Anthropic's multi-year deal with CoreWeave scheduled to roll out later in 2026, what will the competitive landscape of compute scarcity actually look like when these massive physical hardware deployments finally come online? Will the power dynamics have changed entirely?
It ultimately comes down to whether supply can eventually catch up with this staggering demand and, who holds the leverage when those massive data centers are finally fully operational.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.